Gold prices are at historic highs. An ounce of gold now costs around $2,300 after hitting a peak of just above $2,400 in mid-April.
This is a 1 kilogram bar of gold. A year ago, it was worth about $64,000, and today it's worth $76,000.
So what's driving up the price of gold? And with the price at record highs, is it still a good time to buy gold?
I tend to think that when times are tough, when there are economic challenges, geopolitical tensions and so on, investors want to go to those safe haven products, and gold is traditionally seen in that way. What are we looking at when it comes to the outlook for gold going forward?
I think that the gold price is a reaction and a reflection of the level of uncertainty that we're seeing in the world. We're seeing tariffs, protectionism, financial warfare between some of the major global superpowers, and actual war happening in areas of the world as well. I think it's telling that since the 2022 sanctions on Russia, we started to see central banks across the world adopt a strategy to accumulate gold at a much faster pace and quantum than before. And they do so not for short-term profit.
Central banks have bought up over 1,000 tons of the precious metal in the past 2 years. According to the World Gold Council, this demand is due to the precious metal's performance during times of crisis and long-term store of value. Market watchers are bullish on gold and expect it to continue to shine in 2024.
The key thing to note is this: the direction is very clear, and we believe that the key drivers, strong retail buying, strong central bank buying, and eventually strong institutional buying, will push gold higher.
In our bull case, we expect gold price to trade to around 2,400, but we do expect gold price to continue to rally. A lot of sell-side banks now are saying 2,600, 700, 800. So that trend we expect to see going forward.
There is often an inverse relationship between equities and gold. When one goes up, the other tends to fall. However, this time around, gold is rallying despite a strong stock market.
So even though gold usually has very low correlations to equities, gold has actually outperformed US market this year. I think once the equity market corrects, that will continue to benefit gold price as well, because when there is a risk-off environment, investors will tend to go to safe haven asset class such as gold.
Gold is also surging despite a strong US dollar.
It is true to say if the US dollar is strong, gold prices should be weak. But that relationship has broken down because this year US dollar has stayed strong, but gold is also stronger. So it's simply because there are what we call idiosyncratic or separate different factors at play for gold and for the US dollar. Gold is strong retail buying, strong central bank buying, pushing it higher. US dollar is staying strong because the interest rate support is strong for now.
Ongoing geopolitical risks, central bank buying, and resilient demand for jewelry, gold bars and coins are keeping those gold prices strong. So as an investor, how do you get into gold?
The most popular product would be the 100-gram gold bar that I have here, in terms of the number of product actually purchased. In terms of the value of gold, the most popular product would be the 1 kilogram gold bar. Right here I have a 1 gram gold bar. 1 gram of gold is worth around 100 Singapore dollars at present. The premium might add up to 30 Singapore dollars. That's 30% of the value of gold. When it gets to 100 gram of gold, the premium might add up to $100, and that only accounts for 1% of the value of gold. So from moving from a 1 gram bar to a 100 gram bar, you're getting a lot more cost efficiency when you purchase gold. So you're definitely getting more bang for your buck.
Is it better to buy just the gold bar or to buy the jewelry?
I think the key difference is that with gold bars, there's no GST imposed on the gold bars as long as they are considered investment grade gold bars. For jewelry, of course, there's GST imposed on it. So from a cost efficiency point of view, it's definitely more worthwhile to be purchasing gold bars if you view gold more so as an investment.
Another way to invest in gold is through an exchange-traded fund, or ETF.
So we do advise somewhere about 5 to 10% of allocation in gold. I think the cost factor comes into play as well. For example, if you buy a physical gold, you certainly have to pay some sort of premium over the spot price. Also, consideration the storage of the physical gold and where to buy the physical gold. For gold-backed ETF, I think it's very common for investors because it trades like a shares, and then it tracks the gold price. It's fully backed by physical gold, and it's a lot more cheaper. But on the flip side, you can't actually see the gold.
One key factor investors need to pay attention to when investing in gold is the interest rate environment.
I think there's expectation about rate cuts by the Fed, so usually a lower yield environment will benefit gold prices. Actually, last year when the Fed continued to suggest the economy is doing well, I think traders were pushing back the expectation of rate cuts. That did impact the gold price last year.
So the thesis is that once the rate cuts happen, the opportunity cost for gold in gold from institutional investors get lesser. We should see a return, into buying more of gold ETFs.
But while gold may add glitter to your portfolio, it's not without risk.
So as with any, investment, if that asset has had a strong price rally over the short term, and to be candid, gold has rallied a lot over the past 4 months, up by about 20%, there's always risk of short-term profit taking, or there's always risk of short-term two-way volatility. But, as I've said, the emphasis is on long-term allocation to gold, and it has been proven to be a good portfolio diversifier risk.
I think the potential risk for a correction could be that if CPI comes in a very high level, the Fed could increase interest rate. That could be having a negative impact on gold prices.